Right now, as you watch this video, America's largest banks are quietly executing the biggest land grab in banking history. Over 34 regional bank acquisitions were announced just in the first quarter of 2025 alone, totaling $150 billion in deals. JPMorgan, Bank of America, and Wells Fargo aren't expanding because they see opportunity. They're preparing for what's coming. And what's coming is a $957 billion commercial real estate debt bomb set to detonate over the next 12 months. I'm not a doomsday preacher. I just look at the data. And the data is screaming. When the biggest banks in America suddenly start swallowing their smaller competitors at a pace we haven't seen since 2008, that's not business as usual. That's preparation for a storm. So why is the crisis happening right now, in late 2025 and early 2026? The answer lies in a perfect storm that's been brewing since the Federal Reserve started raising interest rates in 2022. For over a decade, regional banks gorged themselves on commercial real estate loans when money was practically free. Office buildings, shopping centers, apartment complexes. All financed at 2, 3, maybe 4% interest rates. Now those loans are coming due, and they need to be refinanced at 7, 8, sometimes 9%. But here's the problem. The properties backing these loans? They're worth 30 to 40% less than they were 3 years ago. Office vacancy rates are pushing 20% nationally. That shopping center that was valued at $50 million in 2022 might fetch $35 million today if you're lucky. So when that loan comes due, the bank faces a choice. Extend and pretend, which means gambling that things will get better. Or force a sale and realize massive losses. Neither option is good. The megabanks know this. They've been running the numbers. They've been talking to the regulators behind closed doors. And they've decided it's cheaper to buy these regional banks now, at a discount, before the real carnage begins. Think about it. Fifth Third just paid $11 billion for a bank that, in 18 months, might be worth $6 billion or less. But Fifth Third isn't stupid. They know something. Let me walk you through the 3 fundamental factors that make this crisis inevitable. Factor 1 is the commercial real estate refinancing cliff. $957 billion. That's how much in commercial real estate loans mature in 2025. That's nearly triple the 20-year average. Triple. These aren't small mom-and-pop loans. We're talking about major office towers in cities like San Francisco, Seattle, and Austin. We're talking about retail properties that were barely surviving even before the pandemic. The commercial mortgage-backed security market is already flashing red. CMBS delinquency rates hit 7.29%. That's 6 times higher than traditional bank loans. 6 times. When the securitized debt is failing at 6 times the rate of regular loans, what does that tell you about what's really happening underneath the surface? It tells you that the assets backing these loans are fundamentally impaired. The buildings don't generate enough rent to service the debt. Period. Regional banks hold the majority of this toxic waste. While JPMorgan and Bank of America can absorb hits because of their size and diversification, a bank with $10 billion in assets that has $2 billion in commercial real estate exposure is in deep trouble. That's a 20% concentration. One bad office tower project in downtown Portland going bust could wipe out years of profits. 3 bad projects could threaten the bank's capital ratios. 10 bad projects? That bank is done. The megabanks are buying these regional banks before the mark-to-market happens. They're getting in while the accounting still shows these loans at par value, negotiating purchase prices based on current book value, and then they'll get to revalue everything. It's like buying a house you know has foundation problems before the inspector's report comes out. You negotiate based on the seller's ignorance, then fix it on your terms later. Factor 2 is the hidden cancer of unrealized losses on securities. This is the Silicon Valley Bank problem, and it hasn't gone away. As of the end of 2024, U.S. banks were sitting on $482 billion in unrealized losses on their securities portfolios. But that number is outdated. Bond yields have been volatile throughout 2025, and experts estimate that if the 10-year Treasury hits 5%, we're looking at $600 to $700 billion in unrealized losses. Let me explain what this means in plain English. During the pandemic, banks bought massive amounts of Treasury bonds and mortgage-backed securities when interest rates were near zero. They paid 100 cents on the dollar for bonds yielding 1 or 2%. Then the Fed jacked rates up faster than any time in history. Those same bonds are now worth 70, 80, maybe 90 cents on the dollar because new bonds pay 4 or 5%. Why would anyone buy your 2% bond at face value when they can get a 5% bond for the same price? Now, these losses don't show up on the income statement as long as the bank doesn't sell the bonds. They're marked as held to maturity, which is accounting speak for we're pretending these will be worth face value again someday. But there's a problem. When depositors get nervous and want their money back, banks have to sell these bonds to raise cash. And the moment they sell, those unrealized losses become very real, very fast. Silicon Valley Bank had $16 billion in unrealized losses on a portfolio of $120 billion. That's roughly 13%. When depositors figured this out, they ran. $42 billion withdrawn in a single day. The bank collapsed in 48 hours. Now look at the regional banking sector today. Many banks have unrealized loss ratios of 8, 10, even 15%. All it takes is one tweet, one rumor, one news article, and the stampede begins. The FDIC recently released a report admitting they were not prepared to handle the failure of Silicon Valley Bank, Signature Bank, and First Republic. Not prepared. These are the people whose entire job is to manage bank failures. If they weren't ready for 3 banks, what happens when it's 20 banks? 30 banks? The playbook breaks down. The insurance fund gets stressed. And suddenly we're in 2008 territory all over again. Insider behavior tells you everything you need to know. The overall insider buy-sell ratio for U.S. markets in 2025 is 0.29. The long-term average is 0.42. That means insiders are selling more than they're buying by a significant margin. Bank executives aren't buying their own stock. They're selling it. Even CEOs, who you'd think would be the most bullish on their own companies, have a ratio of just 0.44, still below historical norms. When the people running these institutions are quietly dumping shares, pay attention. They know what's on the balance sheet. They know what's in the loan portfolio. They know which borrowers are struggling. And they're getting out while they still can at decent prices. Factor 3 is the systemic risk through derivatives and interconnectedness. This is where things get truly frightening. The U.S. banking system holds $223.5 trillion in derivatives contracts. Let me say that again. $223.5 trillion. The entire U.S. economy is around $25 trillion. We're talking about derivatives exposure that's nearly 9 times the size of the entire American economy. Now, most of these derivatives are hedges. Interest rate swaps, currency forwards, credit default swaps designed to manage risk. But here's the problem with derivatives. They create interconnectedness. Bank A has exposure to Bank B through a swap. Bank B has exposure to Bank C through a different contract. Bank C is exposed to Bank A through yet another instrument. It's a web of obligations, and when one thread breaks, the whole thing can unravel. In 2008, it wasn't just subprime mortgages that caused the crisis. It was the derivatives built on top of those mortgages. Collateralized debt obligations, synthetic CDOs, credit default swaps. When Lehman Brothers failed, it didn't just hurt Lehman's shareholders and creditors. It froze the entire commercial paper market because nobody knew who was on the other side of Lehman's derivatives book. Trust evaporated overnight. We're seeing the same architecture today. Regional banks have exposure to commercial real estate. But they've also hedged that exposure with interest rate derivatives. When CRE loans start defaulting, those derivatives get triggered. Suddenly Bank A owes Bank B $500 million it doesn't have. Bank B was counting on that money to meet obligations to Bank C. Bank C can't pay Bank D. Within 72 hours, you have a liquidity crisis that has nothing to do with the underlying asset quality and everything to do with the chain of derivatives obligations. The European Central Bank just released a report highlighting that banks' exposures to non-bank financial institutions are highly concentrated. The small group of global systemically important banks plays a critical role and is difficult to replace. When one of these institutions gets into trouble, there's no backup. The whole system depends on them functioning normally. That's not resilience. That's fragility pretending to be stability. Let me show you how to identify which institutions are most at risk. First indicator, uninsured deposit ratios above 40%. Remember, the FDIC only insures deposits up to $250,000 per account. Businesses, wealthy individuals, and institutions often have millions sitting in these banks. If you're a CFO with 20 million in a regional bank and you start seeing bad news, you're pulling that money out immediately. You don't wait to see if things get better. Uninsured deposits flee at the first sign of trouble. Second indicator, heavy concentration in commercial real estate loans. Look for banks where CRE represents more than 30% of total assets. These banks have bet the farm on one sector. If that sector implodes, they're done. You can find this information in quarterly earnings reports or on the FDIC's website. Third indicator, high levels of unrealized securities losses relative to capital. If a bank has unrealized losses equal to 50% or more of its common equity Tier 1 capital, that's a massive red flag. It means that if they were forced to sell their securities portfolio today, they'd lose half their regulatory capital cushion. Fourth indicator, liquidity coverage ratios below 100%. This measures whether a bank has enough liquid assets to survive a 30-day stress scenario. If this ratio is below 100%, the bank is essentially admitting it can't survive a month of deposit outflows without outside help. Fifth indicator, geographic concentration in struggling markets. A bank heavily concentrated in downtown San Francisco office real estate is in worse shape than a bank spread across growing Sunbelt markets. Location matters. Asset quality varies wildly by region. Sixth indicator, recent management turnover or sudden changes in lending standards. When a bank suddenly announces they're tightening credit standards or there's unexpected C-suite departures, something's wrong. Executives don't leave good situations. Now let me give you 8 specific defensive strategies in order of priority. Strategy 1, verify your deposits are within FDIC limits. $250,000 per depositor, per bank, per ownership category. If you have more than that in one institution, spread it across multiple banks immediately. This is non-negotiable. Yes, it's inconvenient. But losing money because you were too lazy to open another account is inexcusable. Strategy 2, diversify across bank sizes and types. Don't just use regional banks. Have accounts at a megabank like JPMorgan or Bank of America. They're too big to fail, which is a terrible policy, but it's reality. If there's a crisis, the government will save them first. Also consider credit unions, which have a different regulatory structure and often more conservative lending practices. Strategy 3, increase your cash position. I'm not saying go full doomsday and withdraw everything. But if you normally keep 3 months of expenses in cash, make it 6 months. If you're a business operating on thin margins, build a bigger cash cushion. When credit markets freeze, cash is king. The businesses that survived 2008 were the ones with cash reserves. Strategy 4. Review your investment portfolio's exposure to regional banks and commercial real estate. Do you own a regional bank ETF? Do you have REIT exposure? These could get hammered. I'm not saying sell everything, but understand your exposure. If 20% of your portfolio is tied to the sector we just spent 20 minutes explaining is in trouble, maybe that's too much. Strategy 5. Consider Treasury money market funds instead of bank savings accounts for larger balances. These funds invest in short-term government debt and are extremely safe. They're not FDIC insured, but they're backed by the full faith and credit of the U.S. government. Yields are competitive with savings accounts, and there's no $250,000 limit. Strategy 6. If you're a business owner, establish multiple banking relationships now. Don't wait until you need emergency credit. Open accounts, establish lines of credit, build relationships with multiple institutions. When the crisis hits, banks stop lending to anyone they don't already know and trust. Be someone they know and trust. Strategy 7. Lock in long-term fixed-rate financing now if you can. Interest rates might go higher in the short term, but if we hit a real crisis, credit will become unavailable at any price. If you need a business loan or you're thinking about refinancing your mortgage, do it now. Don't wait for perfect timing. Strategy 8. Prepare for payment disruptions. In a severe banking crisis, payment systems can get disrupted. ACH transfers might be delayed. Wire transfers might require additional verification. Have backup plans. Keep some physical cash at home. Have credit cards from multiple banks. Don't assume everything will work seamlessly. Let me walk you through the 3 phases this crisis will likely follow. Phase 1 is the trigger and initial panic. This could start with 1 or 2 regional banks announcing larger-than-expected losses on their commercial real estate portfolios. Maybe it's a major office building default in a big city. Maybe it's a regional bank having to restate earnings because of accounting issues. Whatever the spark, it leads to immediate stock price collapses in the regional banking sector. Within days, depositors at the most vulnerable institutions start withdrawing money. Social media accelerates everything. Someone tweets about long lines at a bank branch. It goes viral. More people pull money out. The bank stock falls 30, 40, 50% in a week. Regulators step in and either force a sale to a larger bank or put the institution into FDIC receivership. This happens fast, maybe over a weekend, just like Silicon Valley Bank. Phase 2 is contagion. Now depositors at other regional banks start getting nervous. Even if their bank is fundamentally sound, fear is contagious. We see deposit outflows across the sector. Banks that were managing their commercial real estate exposure adequately suddenly face liquidity crunches because panicked depositors are withdrawing funds. They're forced to sell securities at a loss to raise cash, which weakens their capital position, which causes more panic. The megabanks offer to acquire troubled institutions, but at fire sale prices. A bank worth $10 billion 6 months ago gets bought for $4 billion. Shareholders are wiped out. Bondholders take haircuts. The FDIC is overwhelmed managing multiple failures simultaneously. Remember, they already admitted they weren't prepared for 3 failures. Now they're dealing with a dozen, maybe more. Credit markets freeze. Banks stop lending to anyone they're not absolutely certain can repay. Small businesses can't get working capital loans. Commercial real estate developers can't refinance their projects. This accelerates defaults, which creates more losses for banks, which makes them even more reluctant to lend. It's a vicious cycle. Phase 3 is the political response and inflation. The government and Federal Reserve can't allow a complete collapse of the regional banking system. So they intervene. The FDIC invokes the systemic risk exemption, just like they did with Silicon Valley Bank. They announced that all deposits at failed banks will be protected, not just the insured amounts. This stops the bank runs, but it creates moral hazard and costs taxpayers. The Fed opens emergency lending facilities, providing unlimited liquidity to banks against collateral. They might even restart quantitative easing, buying bonds to inject money into the system. Treasury Secretary appears on television promising the banking system is safe and sound. Congress holds hearings where bank CEOs get yelled at for 10 hours straight. But here's the thing about all these interventions. They stop the immediate crisis, but they create inflation. You just printed trillions of dollars to bail out the banking system. That money has to go somewhere. In 2008 and 2009, the inflation was masked by the deep recession. This time, we might not be so lucky. We could end up with stagflation, where you have weak economic growth and high inflation at the same time. That's the worst of both worlds. Your money loses purchasing power while your income stagnates or falls. The Fed is trapped. If they raise rates to fight inflation, they make the banking crisis worse. If they cut rates to help the banks, inflation accelerates. There's no good answer. They'll try to thread the needle, but history suggests they usually make things worse before they make them better. So what do you do with all this information? First, understand this might not happen. Maybe I'm wrong. Maybe the banks can manage through the commercial real estate downturn without major failures. Maybe regulators have learned from Silicon Valley Bank and are better prepared. Maybe the economy strengthens and property values recover. It's possible. But here's my question to you. What's the cost of being prepared versus the cost of being unprepared? Moving money around to stay within FDIC limits costs you nothing but an hour of time. Building a bigger cash cushion might cost you a tiny bit of interest income. Diversifying your banking relationships is free. These are low-cost, high-value preparations. On the other hand, what's the cost of being unprepared? You could lose money above FDIC limits. Your business could fail because you can't access credit. Your investments could get hammered. You could be forced to sell assets at the worst possible time because you need liquidity. The downside of unpreparedness is catastrophic. I look at risk asymmetrically. If I'm wrong and there's no crisis, I've wasted a little bit of time and maybe earned slightly less interest on my cash. If I'm right and there is a crisis, I've protected my family and my business from disaster. That's an easy trade in my book. The megabanks are preparing. They're buying up regional banks because they see what's coming. The insiders are selling stock. The data is flashing red across multiple indicators. Maybe they're all wrong. But I'd rather be a year early than a day late. The game being played right now is musical chairs. When the music stops, there won't be enough chairs for everyone. The megabanks are securing their seats. The question is whether you've secured yours. This isn't about panic. This is about prudent risk management based on observable data and historical patterns. We've seen this movie before. 2008 wasn't that long ago. The warning signs were there for anyone paying attention. The difference between people who survived that crisis intact and those who got destroyed was preparation. Some people saw the housing bubble and positioned themselves accordingly. Others ignored the warning signs and lost everything. You have information now that most people don't have. You understand the commercial real estate refinancing cliff. You know about the unrealized losses sitting on bank balance sheets. You see the derivatives interconnectedness risk. You've watched the insider selling. You know the FDIC admitted they're not prepared. What you do with that information is up to you. I'm not telling you to panic. I'm telling you to prepare. There's a massive difference. Panic is emotional, reactive, and often counterproductive. Preparation is rational, proactive, and protective. Move your deposits within FDIC limits. Build cash cushions. Diversify your banking relationships. Understand your exposure. These aren't complicated steps. Maybe nothing happens and we all look back at this in 2 years and laugh about how worried we were. I'll be happy to be wrong. But if something does happen, you'll be glad you watched this video and took action. The cost of preparation is minimal. The cost of unpreparedness is potentially massive. That's the calculation. Make your choice accordingly.